Discretionary earnings, or DE, represent the true earning power of a business. They go beyond net profit to show the cash flow available to the owner-operator. This metric is crucial for potential buyers as it reveals the actual profitability of the business. DE considers all the essential operating expenses, including the owner's salary and benefits, which are often not reflected in the net profit. By adding back these expenses, we get a clearer picture of the business's profitability under different ownership. This is particularly important for small businesses where the owner's role might be deeply intertwined with daily operations. Imagine a small bakery. The owner, a skilled baker, might be involved in everything from baking to managing the counter. Their salary, while an expense, may not accurately reflect the market rate for a baker and a manager. DE helps adjust for this, giving potential buyers a truer understanding of the bakery's earning potential. Understanding DE is crucial for both buyers and sellers. For buyers, it provides a realistic picture of profitability. For sellers, it helps justify a higher valuation by showcasing the true earning power of their business. Calculating DE involves a few key steps. We start with the net profit, which is the revenue minus the cost of goods sold and operating expenses. Then, we add back any discretionary expenses that are not essential for the business's core operations. Common add-backs include owner's salary and benefits, personal expenses charged to the business, one-time or non-recurring expenses, and depreciation and amortization. By adding these back, we arrive at the DE, which represents a more accurate picture of the business's cash flow. For instance, if a business has a net profit of $100,000, but the owner's salary is $50,000, the DE would be $150,000. This adjustment reflects the fact that a new owner might not need to incur the same level of owner compensation, thereby increasing the potential cash flow. It's important to note that while the calculation seems straightforward, determining which expenses are truly discretionary requires careful analysis. A deep understanding of the business and its operations is crucial for accurate DE calculation. DE plays a vital role in business valuation, especially for small and medium-sized businesses. Unlike publicly traded companies, where market data is readily available, valuing a private business requires a more nuanced approach. DE offers a standardized metric to compare the financial performance of businesses within the same industry. This is particularly helpful for potential buyers who might be evaluating multiple businesses. By comparing DE, they can get a better understanding of the relative profitability and financial health of each business. Moreover, Delaware serves as the basis for determining the seller's discretionary earnings, or SDE, a key metric used in valuing small businesses. SDE represents the total financial benefit a single owner derives from a business. By understanding DE, both buyers and sellers can negotiate from a position of knowledge, ensuring a fair and accurate valuation. While both DE and EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization, are financial metrics used to assess profitability, they differ in their scope and application. EBITDA is a widely used metric for larger companies, focusing on operating profitability before considering financing and accounting decisions. It is calculated by adding back interest, taxes, depreciation, and amortization to net income. DE, on the other hand, is more relevant for small businesses and focuses on the cash flow available to the owner-operator. It goes beyond EBITDA by adding back discretionary expenses specific to the owner, such as personal expenses paid through the business or above-market salaries. For example, if a business has an EBITDA of $200,000, but the owner also charges $20,000 in personal expenses to the company annually, the DE would be $220,000. This adjustment highlights the impact of owner-specific expenses on the actual cash flow. In essence, Delaware provides a more accurate picture of a small business's true earning potential compared to EBITDA, which might not capture the nuances of owner involvement and discretionary spending.